We all know what's happening. The largest Series A and Series B in Pakistani history, Bazaar's $30 million and Airlift's $85 million respectively, were announced in the same week, and put together were more than total startup funding raised by all startups in the country over the previous 3 years combined. It has been discussed over and over what will it mean in terms of financing and business strategy for Pakistani startups, and crucially, what could potentially go wrong and how to avoid the more obvious pitfalls. Farooq Tirmizi investigates. With all this happening, one has to wonder, what now? What do you do as a startup founder when you get lots and lots of money from investors? You could splurge on software developers or office space or marketing or customer service, but what you will most likely do is blitz scaling or lightning scaling. To rudely simplify, its core objective is to spend money to get users to come on to whatever platform the tech startup is building, and to do so largely by spending money on incentives that make it attractive for users to stay on the platform. Without asking any executive at Airlift, we can hazard an educated guess that the overwhelming bulk of the $85 million raised by the company will be spent on incentives for drivers and subsidized prices for customers. The goal will be to get more and more people to start using Airlift service, as well as to retain the existing customers. That is the whole logic behind blitzscaling. Essentially, if the value of a business is based on the number of paying customers it has, and there is a certain cost to acquiring those customers, such as paribus, a company's founder and investor will earn a higher return on their investment if those customers are acquired faster rather than slower. And when committing to a blitzscaling strategy, it is absolutely critical that a startup founder have at least a rough idea of when that point would be reached where they have paid for and acquired the number of customers they need. Precision is not important, but accuracy is. So, for example, it is okay for a startup to think that their market is for 10 million people, and it turns out their market was for only 6 million people. It is not, however, okay if they thought that their target market was 100 million people and it was still just 6 million people. How does one determine how big a market one has? Think about every single characteristic that a person needs to have in order to be a customer and user of the company's products and services, and then obtain a close to reasonably accurate estimates as possible of the proportion of total population that meets all the requirements that a user should have. This means startup founders need to have a clear sense of who their customer is so that they can have a reasonably good guess as to how much money they will need. If a startup gets these estimates badly wrong, a little wrong is okay, they run the risk of encountering what can be the kiss of death for a business that has been raising large sums of capital, a down round which decimates their ability to keep raising money to grow. A down round is when a valuation of a startup in a particular fundraising round is lower than it was in the previous fundraising round, resulting in its previous investors suffering losses. If previous investors suffered losses, prospective future investors will be put off, severely limiting the business's ability to keep on raising money, which for a business that has grown accustomed to paying for rapid growth can be the death knell. This is going to be particularly important for Pakistan, considering the fact that foreign venture capital investors are getting their first taste of the market and have never really been through a Pakistani market downturn. One way to avoid the problem for the Pakistani startup ecosystem? For founders not to get too greedy when fundraising and appraising the offers of investments not on the basis of the highest available amount, but the one closest to the startup's needs. That will require holding venture capitalists to a fiduciary standard with respect to their own investors as well as the startup founders. Hence, why VCs need to act as fiduciaries to their existing investors, acting in their best interest even if it does not completely align with the financial interests of the VC themselves. It is a tricky business knowing how much you need and having the strength of conviction to turn down money more than one expected. But for their own long-term financial interest and for the interest of the Pakistani startup ecosystem, Pakistani tech founders need to resist the urge to go for the biggest check sizes if it is in the wrong number, regardless of who is calling and how much they are offering. Greed, in this case, is not good at all.